Hey, everyone. Let's talk about investments and specifically about market efficiency. Now, in the prior discussions, we've sort of laid out a rational approach to investments, including risk and expected returns. But now let's actually sort of step back and take a look at how the empirical record on market behavior supports that, and what deviations from the sort of rationality and expectations and investor behavior that we've laid out as sort of underlies modern portfolio theory and index models and the CAPM, how reality might actually deviate from that. So we'll begin by talking about the efficient market hypothesis, just in terms of sort of what information is novel to the market and what should already be priced in, how we reconcile the existence of certain fairly well-established patterns, in other words, evidence of some predictability in prices, including applications of it, and how finance professionals, what their track record is in terms of navigating potential return predictability. And then we'll turn to behavioral finance, a related chapter, which shows some systematic deviations due to the irrationality of investors. Because even though we try to model the market as a sort of mathematical, deterministic process, it's important to remember that it's really a human construction, and therefore actually contains all of the biases that we bring with us. And we'll discuss what might actually allow these biases to persist, why they don't get arbitraged away, the idea of limits to arbitrage. And finally, we'll talk about how they get reflected in price processes and how they may be captured by investors using technical indicators. So this is all out of Bodie, Kane, and Marcus chapters 11 and 12, and we'll begin with the efficient market hypothesis. This is a foundational idea in finance, and one that is still very much being debated. But sort of most fundamentally what it states is that prices reflect all available information about securities at all times. Now, what does that mean? That means that whenever new information comes out, prices should very quickly, or perhaps instantaneously, adjust to incorporate this new information, which means that there really shouldn't be any sort of predictability just because there's no time delay. Even if there's new information, it should be impounded into prices very quickly. So then what would there be left to predict, so to speak? But that's sort of a bold claim, right? And in a way it's one that stands counter to the idea of active management, that an investor can beat the market. But why has this idea been so persuasive? Well, at the bottom is precisely because so many people are trying to beat the market. It's such a lucrative endeavor, if done successfully, that there's actually a strong incentive for people to pay attention to whatever information is related to the pricing of assets and to trade on it as soon as they can. So that means that whenever there is new information, people should want to trade on it if they have access to it. By trading, they will impact prices, and that will mean that now prices reflect the new information. So in other words, there's a profit motive for anybody who possesses new information to trade on it immediately and adjust prices in doing so. And so that means that you can't really make any abnormal profit. You can't predict returns because any new information is already included in prices. So this is sort of based on the idea of, as many things in asset pricing, arbitrage. That if there is private information or some sort of pricing inefficiency, it's precisely the trading activity of individuals to take advantage of that inefficiency that'll make it disappear. So a classic example of this is the Challenger disaster from 1986. You can view this sort of as an example of the wisdom of the crowd in the following sense. After the shuttle exploded, there wasn't really certainty, at least nobody knew why this happened. But interestingly, if you look at the market performance of 4 companies that actually made parts for the Challenger shuttle, well, first of all, you see that they all had negative returns. That isn't surprising. They were all involved in the making of the shuttle. The shuttle obviously failed. Therefore, all of them were potentially to blame, and all of their prices fell. But if you look more closely, you'll see that one fell by far more than the others. And indeed, sort of after a long investigation by experts of the remains of the shuttle and also the evidence sort of leading up to the disaster, it was confirmed that really it was Morton Thiokol's ring sealer that seemed to have caused the disaster. But interestingly, that is actually what the market seemed to have picked up literally the day of. Now, how could this happen? Well, that may never really be truly known, but most plausibly, it was that somebody actually knew that somebody with inside information knew that it was Morton Thiokol's part that contributed to the disaster. They actually actively traded by selling Morton Thiokol stock, and thereby they moved prices. If it was a single person, they did this to a large enough degree, or if it were a group of people, perhaps their added trades were enough to move the market the way they did. But essentially, the sort of, even though this was likely illegal insider trading, the incentive to trade on that information was perhaps irresistible, and that led to the including of the information that Morton Thiokol's parts were likely the cause of the disaster to be included in prices, bringing the value of Morton Thiokol stock down literally the day of the disaster, much more so than the other companies that could have plausibly contributed to it, but actually didn't. So the idea of the wisdom of the crowd is that once you sort of consult enough, potentially even weakly informed experts, you'll get a better forecast of what's truly going on than any individual expert by themselves. And this is sort of an example, perhaps a very prominent one, of this idea in action. So market efficiency, of course, is generally based on whatever the information set available right now is. And markets are then considered efficient relative to that set of information if you can't make abnormal returns using that information. By the way, what do we mean by abnormal returns? Well, usually sort of what remains after you take out risk factors. So you can view this as an APT alpha from our prior discussion on arbitrage pricing theory, or even a CAPM alpha from our CAPM model. In general, sort of a remaining superior performance once you take into account known sources of risk, whether it's just market risk in the CAPM or multi-factor risk models in the APT. Once you factor those out, the remaining alpha would be sort of your measure of abnormal returns. And that's how we measure the potential market inefficiencies, if such alphas exist. So when we talk about market efficiency in terms of abnormal performance, generally we talk about it in sort of 3 nested levels. But they all talk about whether you can generate this sort of alpha It's just sort of a difference of what it might take to do so. So the three forms of market efficiency are the weak form, the idea that information that is currently known and with regard to which markets are efficient includes current prices, all past prices, as well as other price ancillary data like, let's say, volumes, or if you're talking about derivatives, maybe open interest. In other words, just sort of stuff you can observe by looking at trading activity now and in the past. And therefore, weak form market efficiency says that you can't earn abnormal returns by using that information: pricing, volume, and their historical records. And of course, what that means is that then technical analysis, which precisely tries to do that, to generate predictive signals based on things like changes in price trends, changes in volume. Under the weak form market efficiency, technical analysis shouldn't work. Sort of the next level up says that the information set with regard to which the market is efficient is now expanded, not only to include past trading data, but also all other publicly available information about the markets, which is to say things like fundamental data about the firm, the balance sheet, income statement, any sort of financial disclosures, the quality of the firm's management, whatever projects it has in the pipeline, all the public information that the firm has put out, that should also be all included in prices already. And therefore, under the semi-strong form, you can't earn abnormal returns either through technical or through fundamental analysis. And then finally, the most strong form of market efficiency is that the information set with regard to which all the market is efficient actually includes all information, not just public, not just the historical price record, but even non-public information. And of course, that means that under the strong form of market efficiency, even insider trading, for example, shouldn't work, because even that information is assumed to already be included in the current information set that has set prices. So you can sort of see how these are nested simply in the sense that the information set with regard to which the market is considered efficient for each higher form builds on the information set of the preceding. So for the weak form, it's just the historical price data. For the semi-strong form, it's now a sort of larger circle that encompasses the set of price data, but now adds to it fundamental data and other public data. And then the strong form is an even bigger set that encompasses the prior two and adds to it private data as well. So what does this actually mean? Well, as we were saying, if the weak form of market efficiency holds, technical analysis shouldn't work. If the semi-strong form holds, technical analysis doesn't work, and also fundamental analysis shouldn't work. In other words, sort of the more Warren Buffett type stock picking, looking through financial statements, trying to predict firms that will have a durable competitive advantage. It's not that those things don't exist, it's simply that under the semi-strong form, they're already priced in. So there's no reason to look for them anymore. And finally, under the strong form, literally there's nothing that you can do to earn abnormal returns. Even if you have private information that only you know, the market actually already knows it. So you can see sort of that this is a sequence of increasingly strong statements. The strong form is perhaps verging on sort of supernatural. You know, how is it that if only you know information, the market still knows about it? But the truth lies somewhere along this continuum, and that's sort of the big debate around market efficiency. So if the efficient market hypothesis holds, then price changes will of course still occur because new information does come out, information that nobody knew previously. So for example, let's say that even in the case of the strong form of market efficiency, where everything about the firm was known, some things are simply not knowable. So nobody would, for example, know if some either great benefit or disaster were to befall a firm tomorrow. Either one of their products for some reason became tremendously in demand, or they suffered some sort of disaster in production. Both of those things would still, of course, move prices, but that's because those are new things that simply weren't in the information set of the market or of anybody the day before. So that also doesn't mean that prices don't reflect risk. In other words, if a stock is riskier, there will still be that same idea of risk aversion among investors, still the requirement for a higher risk premium. More risky stocks should offer higher returns to encourage risk-averse investors to hold them. So all of that is still going to be the case. And of course, then that means that on average, the market is going to be right, simply because there's as you sort of advance in the gradations of the strength of proposed market efficiency, there's less and less room to be able to beat the market. And at the uppermost level, at the strong form, there's literally nothing you can do to beat the market. So to beat the market in the long run, you must be either very lucky, because market efficiency doesn't preclude luck, or you must take more than average amounts of systematic risk. So you might not beat the market on a risk-adjusted basis, but you might beat it in an absolute basis simply by holding riskier firms, having a beta in your portfolio of greater than 1, that sort of thing. And of course, market analysis, whether it's just technical in the case of the weak form, or a more comprehensive market analysis, including fundamentals in the semi-strong, won't help you. So how does the market adjust to new information? Well, let's say that the markets are efficient. Stock prices then should immediately adjust to new information. And it means that whatever the current fair value of a security based on the information set at the time, the price should be equal to it. And that's reasonable enough, I think, even under less efficient markets. Whatever is known right now should be reflected in prices. But now let's say that there is a piece of news that comes out. Let's say it's an earnings announcement, and that, of course, will update the fair value of the firm, because it'll tell you something new about how well this firm is doing, generating cash flows now, and perhaps in the future, if there's some guidance looking forward beyond the results of the current quarter or year. And that will, of course, then cause the market price to update as well. So under the efficient market hypothesis, we should have the price reflect the new fair value right after the announcement. But when we sort of look at what might actually go on, indeed we can observe 3 possible outcomes. The first one is indeed the idea that there is an instantaneous adjustment. The value of the firm after the earnings announcement goes up, and the price goes up along with it, and now they sort of stay at that level until there's some new information that comes in. However, you also may observe a case where there is underreaction. So the new information comes out, the new fair value now does update to V1, but price tends toward V1 and reaches it eventually, just not right away. And analogously, you could have fair value updated, the price actually overshoot it, and then at some point decline down, and then finally converge to V1 again sometime down the road. So in other words, sort of either overreaction or underreaction may lead to a convergence of price and fair value eventually, but just not immediately, and it may take one or the other path to get there. So in case 2, prices underreact and they respond with a lag. So of course, if you can predict that underreaction will occur, you can predict future market prices. And indeed, a classic type of underreaction is the post-earnings announcement drift, where there's good news in firm earnings announcements, but prices don't actually fully reflect it right away. They sort of trend upward for a while, so there's underreaction, and then eventually they'll converge to the new fair value. And people have tried to make money on post-earnings announcement drift, and we'll sort of talk about this as an example of an anomaly and what that means for its investability and implications for market efficiency just a little bit down the road. Now similarly, if you have an overreaction, case 3 on the prior graph, that would also lead to return predictability, because you know that first returns are going to go up and then they're going to go down. And that means that you can then again earn abnormal returns if you can actually predict this path of prices in the future. And one example of that might be, for example, the momentum anomaly, where there is first a continuation and then a momentum reversal. But again, that's far from a sure thing. That's simply an example of historically documented market anomalies. But the other thing is, let's say that you do actually observe underreactions or overreactions with regard to specific events. Does that mean that that's automatically a violation of efficient market hypothesis? And does that then mean that you have a free ticket to earn abnormal returns? Well, no. The important idea is that you have to not only be able to predict that either under or overreaction occurs, you have to be able to predict which one will occur. Because think about it this way, if the market, for example, will sometimes overreact and sometimes underreact to the same event, then you can't predictably take advantage of it. Because if you guess that it's going to underreact, but it actually ends up overreacting, well, that means that you might be betting on prices to continue rising, whereas eventually, under an overreaction scenario, they're going to start falling. So if you simply know that prices don't immediately converge to fair values, and there is going to be either or underreaction or overreaction, that's still not enough to disprove efficient market hypothesis and earn abnormal returns, because you still can't exploit the fact that there's not immediate convergence if you don't know what type of divergence will be taking place. And that leads us to sort of a broader point, and this is an important idea in finance. This is one that's talked a lot about in the tension between active management and passive management, the Grossman-Stiglitz Paradox. Obviously, philosophy has a rich tradition of paradoxes, but finance has some as well, and this is a good one. So what the Grossman-Stiglitz Paradox says is that if markets are truly efficient, and they reflect all available private information perfectly, well, then of course there should be no incentive for anybody to collect this private information. Because think about it this way, if we actually grant strong form efficient market hypothesis, you can't make abnormal returns on any information, well, then the only thing you should do is just go passive. Don't bother looking at the records of any firms that you are investing in because you know you can't add any value by doing so. But of course, what that immediately implies is if market participants stop doing research and stop gathering information, well, it means that prices would no longer actually incorporate information, and then prices would no longer be efficient. But then, of course, that means that people would want to come in, perhaps, and start collecting information again, and then prices would become efficient, and then that would mean there'd be no reward for doing so again. So in other words, it sort of seems that the paradox lies in this idea that the rewards for collecting information are actually what drives out information collecting activity in the long run. So what this means really is that there's just an optimal level of inefficiency in the markets. Because if you sort of view this oscillating relationship between market efficiency and number of people trying to collect information about it, you can sort of envision a long-term average where there's just enough inefficiency for people to want to collect information, and they earn enough of an abnormal return in doing so to sort of pay the cost of keeping the lights on, so to speak. In other words, there's just enough inefficiency in the market to motivate arbitrageurs and analysts to collect information about investable assets. And if you think about it in economic terms, that must mean that the marginal benefit is equal to marginal cost. In this case, the marginal benefit of trading on information that you collect must be equal to the marginal cost of gathering this information. So that's sort of an argument for why probably the strong form of the efficient market hypothesis shouldn't be what we really expect. We should expect some inefficiency in even sort of the best regulated, the most liquid, in general sort of the best maintained markets, simply because inefficiency really is also the way that information gatherers in financial markets actually pay for the costs of gathering that information. So how do we actually sort of settle this debate about market efficiency? Can you, for example, make abnormal returns with technical analysis, thereby disproving the weak form? Or can you make abnormal returns with fundamental analysis, disproving the semi-strong form? Or can you make abnormal returns with insider information, disproving the strong form? Well, unfortunately, detecting these violations is not straightforward. Obviously, there's a lot of, for example, accusations of insider trading, but oftentimes they're not conclusively proven. And more importantly, it's harder to still tell whether the individual that tried trading on any of these information sets actually made abnormal returns after transaction costs, and whether they were exposed to other risks that can explain the higher returns that they earned. Because remember, abnormal returns are measured relative to some sort of risk model, and if we think about it in APT terms, some sort of set of linear risk factors. So one other wrench in the works is simply that, well, perhaps we didn't have the one missing risk factor that would actually explain whatever abnormal returns we saw. So that's sort of why the debate about market efficiency is still ongoing, just because of the difficulty of measuring abnormal returns and what sort of their risk-adjusted actual performance actually would be.